What's up, guys? Welcome to another video. What if I told you there was a secret formula which determines what stock doubles in a year, and the same formula determines a stock price being flat for many years on end? It's not luck, it's not magic, it's just a formula. Most new investors, and I include myself in that, chase one thing: earnings growth. And that's not a wrong approach, but it's not a holistic approach. Smart money look at two things, the twin engines for growth, if you will. They look at PE re-rating and earnings growth. When these two factors combine together, it can drive stock price returns in a very powerful way. So in today's video, we're going to talk about what drives this double twin engine of growth, and we're going to look at three real life case studies from the Indian markets in the recent past. I don't know if you guys have noticed, but have you seen some companies that are consistently growing their profits by 20% year on year, but the stock price has been more or less flat or hasn't appreciated the way the earnings growth have appreciated. On the other end, you see some companies that are loss making that continue making losses, the same amount of losses or even more losses, but sometimes the stock price just appreciates. Now, why is this? It's because the earnings growth just tell you half the story. Now let's look at this graphic. In scenario A, we have a company which has grown its earnings by 20%, but due to whatever reasons, the PE ratio has stayed constant. Your returns will be limited to 20%. Now in scenario B, the stock price has grown the same 20%. The earnings have grown the same 20%. But for whatever reasons, the market has re-rated the PE to 1.66 times. This leads to a 2x return in your stock price. I'll explain further in this video. To explain what I just said, you have to understand the stock price is composed of two elements: the earnings per share or EPS, and into the PE ratio. So the earnings per share times the PE ratio is basically the stock price. Now, if we multiply this by the total number of shares, we'll get the market cap of the company is equal to the total profits of the company into the PE ratio. If this sounds very complicated, I will explain further. So I'll explain my point better by looking at some real world example of some companies to determine what the PE ratios is and the earnings per share is. Let's start with Ami Organics. So we can see that the market cap here is 13,786 crores. We can just copy paste this into the sheet where we have market cap. And now the net profit for Acuitas is, you look at the trailing 12 months as net profit, it's 224 CR here. You can copy this into this. And this gives us a P ratio of 61.5, which we can cross check here, 61.6. So this is basically shows you that the market cap, the PE ratio is basically the market cap divided by the total net profit of the company. Now you can also divide the total number of shares outstanding by the market cap to get the current price of the company, which is 1682. And you can divide the total net profit of the company, which is here, by the total number of shares outstanding to get the EPS. So going back to my point, the PE ratio is the current price of a company is basically the earnings per share times the PE ratio, and the market cap of the company is basically the net profit times the PE ratio. To further illustrate my point, let's open another company, Narayan Hudade. Here we'll look at the current price, which is 1858. We'll plug this in here. And we can divide this by the EPS, which the trailing 12 months is EPS, which is here. And this should give us the PE ratio too. 44.93, which we can cross check here, 44.6, yeah. So that's basically what the PE ratio is. To explain my point, let's look at two apartments. Now let's think of the annual rent collected. For example, illustrative purposes, let the annual rent collected be 1 lakh. Um, in apartment A, suppose you can purchase the apartment for 15 lakhs. Your PE ratio would be 15, right? For the same, now let's look at apartment B. If you can purchase this apartment for 30 lakhs, your PE ratio is 30. For the same, the annual rent collected is 1 lakh in both scenarios. But for apartment A, the total value is 15 lakh, giving us a PE ratio of 15. And for apartment B, the total value is 30 lakhs, giving us a PE ratio of 30. Now, why do people at times pay more give higher multiple for the same amount of money earned, 1 lakh? Why are people giving apartment B a much higher premium? Well, that's because using this example, you can say things. You can think that around apartment B, the area is becoming very developed. There's a lot of nice outlets and commercial opportunities around. So this makes the person buying the flat think that in the future, this 1 lakh earned in EPS can become 3 lakhs, making the forward PE, which is 30 lakhs divided by 3 lakhs, making the forward PE just 10. So it's basically a premium given for future growth, for future quality and safety. I hope this example helped illustrate why, even though two companies might be earning the same amount, why the market prescribes higher PEs to company B over company A. In the real world, these can be things like a stronger moat, higher barriers to entry, ability to protect margins, higher gross margins, less competition. All of these more innovative companies usually command higher PEs where there's higher future growth expected. So all of these are scenarios why a market might prescribe one company a higher multiple, although it might be earning the same as another company. This slide just explains my earlier point that if the earnings grow at 20%, but suppose the stock was at 15 PE and now it re-rates to 25 PE, that's a formula for a multi-bagger because your EPS growth is 20%, but your PE has grown by 66%, and the multiplication of both gives you a doubler in terms of stock returns. So you have to look at earnings growth. Of course, earnings growth is very important. It's one of the most important things in fundamental analysis. And earnings growth is driven by sales growth, it's driven by margin expansion, it's driven by debt reduction. This is the company's performance. But one factor that maybe not, if not ignored, is definitely not given as much importance is market perception, which is the PE rating. These are usually driven by things like improved sentiment around the company, this industry tailwinds. It could be something like government regulation in a particular industry that favors that particular company. This is all the market's perception. And actual magic or actual liftoff when happens when both engines fire together at once. All this sounds very theoretical and complicated. So now let's just go to three real world examples, things that happened in the last decade with three very big companies to further illustrate my point. First, we look at HDFC Bank, which had a one engine on and one engine off. Basically, their earnings per share was growing at a good rate, but their PE ratio was derating. In Tata Motors, the opposite scenario, where the earnings per share was declining and was negative, but the PE ratio re-rated for due to various market reasons. And in Varun Beverages, where both engines were firing together. And what happened? Let's look at all of three examples, starting with HDFC Bank. So let's look at HDFC Bank between 2019 and 2023. In 2019, the earnings per share EPS was 39 rupees. By 2023, this doubled, more than doubled to 80 rupees. Whereas the PE in 2019 was 29.5. Due to the merger and the complications with the merger of HDFC and HDFC Bank, the market severely derated the stock, and the PE fell from 29.5 to 20 between 2019 and 2023. And what was the outcome in the stock price? Usually, if you see a company doubling its earnings per share in such a short period, you would think that there would be a very good outcome. But let's see what happened with HDFC Bank. Yep. So in 2019, we can see that the stock price was at around 540, and in 2023 it had reached. It was hovering at 750, 800, which is not a very good outcome for a company that's doubled its earnings in this much time, right? This is why you need the PE. If not re-rating, you should at least find companies where there's less chance of PE de-rating, because this does hamper your returns. This is why everyone, many experts and books you've read, like prescribe value investing and the importance of finding companies that are economical in terms of the valuation multiples given to them. Now let's look at our second example, which is of Tata Motors. Now, Tata Motors between March 2020 and November 2021, they were loss making and their earnings were very sporadic and all over the place. Their losses varied, but in March 2020, their EPS was minus 30, and by November 2021, they got it up to minus 10, but it was still loss making. But let's see what happened to the stock price. It zoomed from 70 to 500, um, because of just the market ascribing a very high multiple because of the hype created around a future EV story that the company was selling to investors. If we see the charts of Tata Motors, obviously this is post split, so the prices, the figures will be different. But if we see it was 3940 rupees in April 2020, and it zoomed to more than 300, giving you a seven-bagger returns in such a short period of time, purely driven by PE re-rating and market sentiments, and nothing to do with the earnings growth of the company. Now let's look at the third scenario, which is the dream scenario that we should all be looking for when we're researching stocks and identifying opportunities. Now, in the case of Varun Beverages, if you see in 2019, the stock price was rupees 85. The earnings per share was just rupees 1.8, and the PE ratio was around 47. What happened to the earnings per share between 2019 and 2023? They rose from 1.8 to 8.8, which is like almost an 8x growth. What happened to the PE between 2019 and 2023? It re-rated from 47 times to 90 times, which is like almost doubling. And what was the result? It was a beautiful 10 bagger where the stock price went from 85 rupees to 800 rupees in this period of time. And this is the importance and the power of twin engines and both engines of growth firing together. Um, when a company is able to grow its earnings at such a strong and steady rate, the market usually does identify and recognize that growth and reward that growth in the form of PE re-rating. And this, like in the case of Warren Beverages, it was like an execution story that was perfectly done. And yeah, we all know, we've just seen the outcome here. Now, I'm sure you're thinking these are great examples, but what use is hypothetical stories and how will this help you in your research? How can you look for twin engine stocks that are approaching liftoff or just before liftoff? The first thing to look for is companies with a low PE ratio. This is relative to their historic lows and relative to the industry low. It doesn't have to be low in absolute terms, but low compared to their own historic averages and compared to their peers. And this reason for this low PE should be like a temporary problem, a fixable problem. It can be like a short term marginal issue, it could be some temporary government regulations towards that sector. But anything that's temporary and not a structural decline causing a depressed PE, but you know that the company is capable of growing their earnings significantly and strongly. Um, these are ideal stocks where you can see like a recipe for a twin engine growth, because as the earnings grow and the temporary problem is resolved, both engines will be firing together. um, what will fix the problem and restart like the temporary problem getting resolved? This can be like resolution of a problem. It can be a management change, it can be severe deleveraging and debt reduction. It could be like for a cyclical stock, the commodity cycle going back in favor. So these could all switch on twin engine one, and then with earnings growth combined, they can give you like the twin engine for liftoff. So hopefully this was informative. Moving forward, always when you're looking at the PE ratio of a company, always ask what is the market's current perception of the company. Is there room for this PE to improve? Is the PE already very very elevated, and will like earnings degrowth or some sort of sentimental shift cause the PE to derate significantly? Because the magic is the multiplier. When you find a company which with a relatively low PE, which is ripe for re-rating, along with a company that the earnings growth, you see a clear trajectory for the earnings to grow significantly. There's always magic when both factors work together for you. Hopefully you've learned something in today's video. I know this was a little more technical and boring, but it's an important concept for new investors, and it's something important even for us investors who've been investing for a few years to keep in mind. Yeah, I hope you found something of use, and please feel free to leave any comments if you have any feedback for me, and like and subscribe this video if you feel it. Thank you.